So naturally, there is an attempt to start moving this money out of these national banks that look to be possibly endangered. So if Greece goes, for whatever the reason, and certainly you could make up lots of possible reasons, then people would start, I think, in turn, pulling money out of Portuguese banks, maybe Irish banks, maybe Hungarian banks, maybe Spanish and Italian banks, who knows? These are all risks that people in those countries have to weigh. The governments themselves are trying to clamp down on currency flight. And even they're trying to clamp down as well on cash transactions. So people can't take any large amounts out in cash. One of the countries, and I've forgotten which one, has a limit on cash transactions of $1,000. You're not going to get much money out of those countries. $1,000 you can do in cash. Other than that, it has to be non-cash. So an interesting phenomenon. If you look over to, and these are, by the way, those are symptoms of countries in financial travail, obviously, when you've got countries imposing currency restrictions like that. If you look here to the last page in the booklet, you'll see what I'm trying to get people to think about who don't really wrestle with bonds and bond prices and bond yields all the time. Most people feel, oh, I'm comfortable if I buy a bond, especially a secure bond like a treasury. Okay, maybe I won't make much, but it'll be okay. I'll hold it and it'll be okay. But this is what can happen to the value of your bond if yields go back up. And we've chosen future valuation dates. The first date is just a year and 2 months from now. And we're saying if the yield went up to 375, when we computed this, it was at 188. That's the 10-year US Treasury. If it goes to 375 14 months from now, and we chose 14 months from now because it was 375 14 months ago. So if it goes back to the same level it was in the equivalent amount of time, the price of the sale would be here, and you would lose 13.7% if you had to sell on that date. Now, in the meantime, you'd have gotten your interest, which would have been about 2.3%. So your net return for holding that bond for 14 months would have been a negative 11.4%. And then we went on to 2 more dates. We went on to just about 2 years from now. If the yield were 401 on that date, because it was 401 2 years ago, you would lose 14.25%, but you'd have made 3.8 in yield. So your net loss for 2 years holding that bond would be 10.5%. And then if you held it another 2 years, so a total of 4 years from now, and if you ended up selling it at 427, which is what it was 4 years ago, you'd have lost 1246, but you'd have gotten 4.9%, you would have gotten 7.6% in interest. So your loss, if you held the 10-year US Treasury for 4 years, and you collected all your coupons, and you put them all in a pot, and then you sold your bond there, you'd be out almost 5%, 4.9. So, and when of course we don't know why the yields went up. If inflation started to go up, you lose 4.9 plus whatever the rate of inflation is in terms of your actual purchasing power. Might you have wanted to do something else with that money in that time period? Who knows? But at least this is what can happen, and this is with a very secure US Treasury. If you put fear into the equation with bonds that are of greater risk, you change the equation continuously or considerably. So, although we see common stocks in the United States just about 4% off their 3.5-year highs with solid earnings, they've had solid earnings for the last 2 years, we're faced with a world still with extreme problems and great uncertainties. The rating agencies have dropped the credit ratings of countries around the world, including the United States, and there are more pending. Legendary hedge fund guru George Soros warns that the current crisis in Europe is more severe than the 2008 crisis. that nearly brought the world financial system to its knees. He said on Bloomberg that it's more important right now to survive than to get rich. And he characterized the current situation as the most difficult he has seen in his career. A couple of other quotes from all recent quotes. Governor of the Bank of England, Mervyn King, said recently, "The crisis in the euro area is one of solvency and not liquidity. And the interconnectedness of major banks means that banking systems and hence economies around the world are all affected." Former St. Louis Fed Reserve President Bill Poole recently said, "We are only a few years behind Greece when you look at the numbers." That's a former Fed governor. And just last week, in a TV interview on Bloomberg, Alan Greenspan, of whom I have never been a great fan, right after encouraging the Fed to allow markets to heal after years of policy interventions, I wish he had eased some of the policy interventions that he exercised, but he made the comment, when the pain comes, it's going to be very, very severe. That's a very dour outlook, and it's very much in concert with what we have been saying for more than a dozen years. Obviously, our government and governments around the world are doing everything in their power to put a brighter face on the situation, and in fact to change the unfortunate reality. They're trying. They've succeeded in part, especially in this country, over the past 3 years, and they could continue to kick the can down the road. That is obviously the intent of governments and central banks around the world. On the other hand, we believe that the long weak cycle that began in year 2000 probably has a few years yet to run, and it's likely that economic conditions are getting closer and closer to breakpoints. What's an investor to do in such an environment? It's important to recognize that whatever you or any manager chooses to do could very easily be wrong. Whatever your choice, even stuffing cash in a mattress could prove to be very wrong, unsafe. We could face serious inflation or deflation, or both, depending upon government decisions and market reactions. Stocks could soar if governments flood the world with new money and inflate the debts away. They could plummet if debts begin to collapse. Bonds could provide a moderate return if interest rates stay near historic lows or fall even lower. But bonds could be decimated if interest rates begin to rise rapidly. Gold could be a great hedge against runaway money creation, but it could fall much lower if governments and central banks suddenly got religion and began to slow their money creation. Most of all, we encourage investors, as we have for some time, to stay largely liquid and flexible. This is an environment in which conditions and investor attitudes could swing drastically and very, very rapidly. We're in that flexible position right now, and we're ready to respond to potentially rapidly changing markets. I don't think we fully appreciate how much markets could change, and very, very quickly. The conditions that are out there are incendiary, and we don't know how they're going to unfold. Bernanke doesn't know how they're going to unfold. The ECB directors don't know how they're going to unfold. They're doing the best they can, in their view. I would disagree with the idea of flooding the world with money, but that's their view, and that's what they're attempting to do. But if we start to see a few of these things unfold that are at least